In trading, knowledge is power, and lack of knowledge in what you're doing can be costly, very costly. So you need a solid foundation of quality market education. Whether you're new to trading or a seasoned veteran looking to add advanced strategies to your arsenal, there's always something to learn and something to improve on. And now you can access the same knowledge that professional traders receive with Market Rebellion's Trading Education. I'm Bill Johnson, Head of Options Education here at Market Rebellion, and we've assembled a comprehensive curriculum based on decades of real trading experience, covering everything you need to know about trading options from beginner to advanced. We go way beyond the nuts and bolts of options theory to teach you how to apply specific trading strategies and the techniques needed to adapt your trades when markets shift. Regardless of your goals, you'll gain access to the education you need with easy-to-consume lessons so you can learn to trade with confidence, enhance your knowledge, and master the practical skills required for market success. So please join us for in-depth trading education only from Market Rebellion. Hey, good afternoon once again, Market Rebels. It's that time again for Coach's Corner. Stu, this seems to be rolling out about once a week, seems like.
Let me check my calendar. Wait, can I hedge the calendar, Bill?
Exactly, hedging theta. We just talked about that, but it does seem to roll around awfully quick. But here we are again, and we have another very cool topic, and we came upon this one just from some trader talk that we hear in some of our Q&A sessions, some of the chat rooms, and we say, that's not good. That's a bad...
That's a good point, Bill. So everybody knows we get our ideas to do these topics from you.
From you.
From
you. We're watching. We're watching.
The chat rooms. We do coaching sessions, and this is what we get. We don't make this up. This is
right. This is very big problems that people have.
Yeah.
So let's take a look. Let's start with our Chalk Talk question, our little thought-provoking question. And let's say an out-of-the-money put has an 80% win rate. Now, that's just a made-up number, but your broker's platforms, a lot of them will show you a calculation that says if we had these conditions over and over, 80% of these would win. So what we're talking about here is that this would be for a short option. So it's a...
Bill, it's not really a made-up number. I mean, this is a number that we get a lot.
We can. I'm just saying for this example, I just made it up.
Didn't we hear some guy up on stage say?
Yes, we did.
80% of these are going to go out.
80% of the out of the monies, and therefore it's the secret code.
Therefore, you got to hit the button, hit the send button, and do it, and you'll buy your
money from.
Guy.
Yep. So here's the thing. I probably should have written that an out-of-the-money put has a 20% chance to go in the money. We're talking about a short option. So because this becomes a very common idea, as Stu just mentioned, people think, well, let's go sell this. I'm going to win 80% of the time.
Yeah,
what could be better?
Sell side.
So the question that we want to ask here for today, if 80% is good, is it safer to go more out of the money and find one that might be 90%? I'm going to win this 90%. If 80% is good, if traders are going to pound the table about, hey, you can win 80%, well, why not 85? Why not 90, 95? And then sometimes we'll say, well, those puts are getting cheaper. True, but then how do traders push back? Sell more of them. So that's really what we want to explore here. Is it really a better idea to go from 80 to 90? Once we answer that, you're going to question going from 75 to 80 or 65 to 70. We're going to see there is a very serious risk hiding here.
What's the connection? You got to think.
Yeah, what's the connection?
What's the connection? Not just with the money, but where does the money come from? Like you're selling more puts, they go in the money. You have bigger deltas.
Who's funding it? Yep, we ask that all the time.
the L on the P&L side is getting bigger. Who's paying the bill?
Who's paying the bill?
Who's paying the bill?
So here we go. Selling out of the money puts. Why does risk accelerate? Might not make a lot of sense now, but it will later. What we're showing is that the further you go out of the money, it's not a linear risk. If I can go 80% and win a dollar, if I go 85%, maybe it drops 25 cents. And if I go 90%, it drops another 25 cents. That's how a lot of traders think. We're going to see it accelerates like a rocket as you start going further and further out of the money. But the question is why? And why should we expect it to do that? Well, to do that, we have to go back to some of our previous coaches' corners. So let's, to make the point, let's put 10 numbers into a hat. And let's say that I'm going to let you win if you draw the numbers 1 through 8. Okay, you obviously have an 80% chance to win. We'll make it a dollar. You have an 80% chance to win a dollar. Now, here's the first illusion that traders fall into. They go, well, gee, 80% of the time I'm going to win a dollar, and 20% of the time I'm going to lose maybe a dollar. Stop right there. That is not true. That's the illusion when people think I've got an edge by winning 80% of the time. They assume the dollars are equal. Well, if you can see that you've got an edge and an advantage by winning 80% of the time, you don't think the other side can too? You think they're going to say, yeah, I know I'm taking the chump side of it, but I feel generous. I'm just going to give you some free money here. It's not happening in a market. The market realizes this too. And the only way you can get somebody to take the other side is to do what? How do we do it in a football game, Stu, if we see that one side clearly appears better? How do we
Well,
balance it?
push the odds.
You
So
push the odds. What are you doing here? We're going to do the same thing in
we're
a
going to
different
push the
way.
odds with the dollars. People often
Correct.
assume, but really because they just don't think it through,
Correct.
that the while the percentages and the probabilities may change, that the dollars
That the
remain
dollars
constant,
don't.
and that simply is false.
Right.
Right?
It's
There's
like
no way
saying back
around
to the football bet, there's a 50% chance that team A is going to win. All right, well, there's probably no point spread. Oh, but look, they're predicting an 80% chance for team A to win. Let me go bet on them. No, the crowd knows that there's a point spread to compensate that. It's exactly the same thing here, and traders, for some reason, miss it.
it. Yeah.
So this gets back to fair value, and the fair value is an idea of there's a balancing point where if we were to do this bet over and over and over, we would expect to just break even. So here's how we can figure it out. We have an 80% chance of winning a reward. I just said a dollar. And we have a 20% chance of losing some other number. Now, I'm going to tell you right now, it's 4. We'll show you how we got that in a moment. But if we multiply these out and add them together, we get 0. 80% of a dollar is 80 cents. 20% of $4 is, or negative 4 is negative 80 cents. Plus 80 minus 80 is 0. So what this tells you is just a very quick shortcut to say if we did a simulation in Excel for 5,000 times or 10,000 times, we would both be sitting with just about 0 money. You could go through pockets of wins or losses, but overall you're just going nowhere. So how do we pull this $4 out of the hat here, Stu? Well, one way is to just look at this ratio. The 80% person is winning at a rate of 4 times the rate of the 20% person. So right there are your odds. It's 80 to 20 or 4 to 1. So that's where that 4 is coming from. So no matter what the reward is, the risk, let's call it, has to be 4 times bigger. If I made this an 80% chance to win 10, the market's going to make that 40. Now, a lot of times people say, oh, that's just an outdated academic theory. That's not the way that markets work. Expected value is nonsense. That's the biggest nonsensical statement ever. The only way you can talk about price and have a conversation about price being low or high is you have to have a reference point. And the reference point is, well, let's start with what's fair. So that's one of the reasons we have to say that the market should be anticipating, if you're going to take this side of the bet, they should be expecting a point spread of 4 times.
And fair is, that can be deemed as a bit of an abstract concept
Oh, yeah.
in and of itself. Now, fair value On the options matrix, calls versus puts, I mean, that's just a mathematical,
Right.
that's just arithmetic.
Yep.
But what's fair? Just 20 vol fair, 25 vol fair, 30, like I don't know. I have no idea what that number really is,
Well, the
and
margin of
neither does neither do you, Bill, or neither does it do any of us. But the market kind of figures it out, and
yep.
bidders and offer and seller buyers and sellers, bid and offers. That's what the markets do. That's the auction market,
Yep.
and we come
It's
up with an implied volatility number.
it's exactly the same idea, which is why we keep using this for an example of a football bet. How do we come up with a 7-point spread or a 3-point spread? Is it right? Probably not. But under the current conditions, that's the point spread that balances the market. We get an equal number of buyers and sellers.
Yeah.
So think about that analogy there. If you think of it like a seesaw, if I put a 1 pound weight or a $1 weight over here, and we have an equal distance from this is called a fulcrum in physics, this little triangle here, the balancing point. If that distance to the left is the same as the distance to the right, then I could balance it with a 1 pound weight on this side. But it's not going to be because we don't have equal probabilities. So here's what's happening visually. If I slide this over so that this has 80% of the length, and this obviously must have 20%, what's the only number you could put over here to keep that in balance? It's got to be 4 times. And so you can see that if you remember from physics, 4 times this distance has to equal 1 times this distance. That's what's keeping it in balance. So when you see that I've got an 80% chance of winning a dollar, you have to think, why would the market give me that opportunity? Because there's a 20% chance you're probably going to lose 4. This is going to pack a real punch. So the first thing to understand is that the higher the win rate, the greater the losses must be. Also remember that price is the point of disagreement. We can't quite tell if 1 in 4, kind of what you talked about, is fair, but it is a price where we agree to trade. But the reason you might take this bet is you think the options price is too low, the seller thinks it's too high. But we can't really make a strong argument either way, so we're willing to trade there, but we still have some sense of value. So if you think that selling this put for $1 is a screaming great deal, that's the part we hear from traders, right? Oh, look, it's a screaming great deal. You're going to win 80% of the time. End of story. No, it's not. Ask why somebody would be willing to buy it. Would you? If I came up and said, I'm going to win 80% of the time, you want to do it dollar for dollar? Of course not. Well, don't expect the market to either. And yet, this is what traders are claiming when they say, oh, it's like, what have we heard, Stu? Printing money. It's like taking candy from a baby. I
These
call
are
it,
all quotes from
these
the
are all
chat.
quotes from
Yeah.
people that have told us this is the way. It's a gift from the markets, selling these out of the money options. They're
One
not
one
under
percent of the stock price is free
all
money.
these formulas and it's free. Exactly.
So
Right.
what's going on here, really, guys? It's the market is compensating you with a dollar
Of
amount
course,
for the liability that you're willing to take.
for taking the bad
And the
side of the
higher
bet.
the probability that you're going to win, the lower the dollars that you're going to get paid, and the higher the money that you're going to get banged on if it goes the wrong way. Look, it's as
That's
simple
right.
as that. Look at
Right.
your own matrix. Keep going further and further out of the money. I
Right.
think you're going to find that there are less dollars involved.
Right. If you look at in sports betting, it seems to make sense to people, but not in options. They completely get it backwards. But think of, I'm trying to think of maybe like when Mike Tyson was, just completely unbeatable, and you might have to bet 1,000 to win 100. Why would anybody do that? Because he's the overwhelming favorite.
Because it was a
Favorite.
layup.
So because at least that's the way the market sees it. Why would you bet on the other guy? Well, because for 100, you might be able to win 900. And they say, all right, there is compensation. And they go, oh, that makes perfect sense. And then
Hmm.
we come into the options market and they go, oh, no, you're going to win 80% of the time. They're never looking at how these ratios got there in the first
So
place.
here's the part that we always have to do, Bill. We are not saying don't sell a put.
Correct. We
We
do it.
we are
Right.
not selling. We are not saying don't sell a call. We are not saying any of that. We are again. We're going to keep pounding the table here, simply saying, understand
Right.
what's going on and
Right.
what the liability actually is, and do your very best to quantify what it could be to make
If
sure that
if
you
things
can
go wrong.
show up to work tomorrow.
Yep.
That's the game.
So let's take a look here. Let's say that this was 90 cents. What's going to happen here? The market's going to say I have an 80% chance to win 90 cents. The market's going to price that at 4 times bigger or 360. All right, now what if we do this? What if we have traders might claim an edge and they say I win dollar 80% of the time, but I only lose two. Maybe they say I'm using a stop or something. That's not going to protect you. If you want to make this two, if you really think that's true, what's going to happen? This now becomes the overwhelmingly better side. Nobody's going to take the other side. And they're going to say, okay, well, if this is going to be two, this has to be 1/4 of this. This has to be 50 cents. And now it's going to balance.
And in practice, that two really opens up at 7.
Yeah, exactly.
Right. Yeah.
So now this also gets back to another concept we've talked about before. There's a thing in finance called the expected value triangle, and it just shows that there is a deep connection between the win rate, in this example, 80%, the average gain, let's say $1, and the average loss of $4. They are connected by what? The probability. So here's why they call it the expected value triangle. You can choose one of the corners,
Yes,
but
you
you
can.
cannot choose more. I cannot say I want an 80% chance to win $4, but I only want to lose 50 cents. That's trader talk. The market is not going to allow it.
But people, what how am I trying to say this? People talk themselves into believing that
Yep.
they can create that
That they
third
can't exactly. I
with
want to
with a stop, with a
right.
trailing stop, with a
Not happening.
50% thing, with
Yep.
a double, with all these things that are
Rules.
completely out of their control. Yeah, yeah, maybe that can happen,
It could
but
happen, but you
maybe
can't you
it
can't
can't.
force it. Right.
You can't force it. The market is going to do what the market is going to do, and you're on that train. And
Right.
I don't know where it's going to stop for you to get off the train. And you, that's what we do here, right?
Right.
That's what we're trying to
Right.
convey. That you need to do your best to understand what the consequences are if in fact you're wrong. We all know. Look, when you sell the put for $2 thinking it's free money, we all know how much you can win, right? $2.
Right.
But what you don't know is how much you can lose.
Right.
And
But they think
that's
it's a non-issue because it's only a 20% chance or a
yeah.
10% chance, and
And
that's where they're wrong.
decades of trading says that
It's
is
not happening.
100% it.
So it's the same thing in our football bet. You can say team A is the favored team. Well, let me go to the sports book. I want the favored team, but I also want points and I also want a bigger reward. People would say that doesn't work that way, but
No,
then you get into the options market and they go, "Oh, that's exactly how it works."
exactly how it works, right?
It's not. It's the same thing. So we're going to show you some neat things about why this accelerates. And before we do, take a shot of that QR code right there. You can join us every Tuesday, Thursday. Tuesday we have beginner, intermediate. Thursday is advanced for Q&A, and we have topics.
Bill, isn't it beginners and then intermediate and advanced?
I thought it was. Maybe it is. I think
I
you're
don't
right.
know.
I always get that backwards. I
Just
think you're
come.
right.
It doesn't matter. Just show
I
up.
think it's beginners and then intermediate advanced on Thursday, but
We welcome everyone to
we
both of
do. But we have topics just like this. Uh, you can jump in there and ask questions. We have a lot of fun. But if you like topics like this and learning about markets and options, this is the place to be. Okay, so why does risk accelerate? That's really the premise of today's presentation. That was kind
Yeah,
of the
this is cool.
backstory.
This is cool.
Here's the thing to understand. Half the contracts lose. That is something that escapes nearly every single trader. Everybody thinks that if you follow the rules, I sometimes make the analogy like it's a game show where everybody can reach up and grab this money. It's a outside sponsorship, dumping a bunch of money. If you win, everybody can win. You just have to know the rules of the game. That is not how a financial market works. It's more like a poker game. The only time that you lose is you are taking it from, that you win is you're taking it from somebody who lost, which is the other side of the bet.
I believe they
So,
call it the zero-sum game, don't they, Bill?
a zero-sum game. So the only way that your long option earns money, the only way, is because the short option lost money and vice versa. So and it's not just at expiration. At any time, if we mark to market, if you're up $1.50, the short position is down $1.50.
And
It
again,
has
no
to be.
no hedging in here. This is
Right.
just
It's
the
just
option.
straight up the option. And it
Yeah.
should make sense because if I buy the $100 call, I put a plus sign, think of it in my brokerage account, I'm long it. Stu is short it, he puts a minus sign.
Yeah.
It's the same option.
Bill makes $3, I lose $3.
It's one's got a plus, one's got a minus. It
That's
has to
it.
work out, but
Yeah.
traders all argue that to the death. Oh, that is not true. Everybody can win. That's a big fallacy right there. Trading is a competition. Remember, it's more like a poker game, and therefore half the contracts lose. The losers pay the winners. Now, let's find out why the risk accelerates and why it becomes super dangerous to keep pushing those probabilities higher and higher for these out of the money put sales. Let's say that we have a 50% chance to win. There's a 50% chance to lose. What was the calculation we saw? We divide these out and we get one. What does that tell us? You have to bet $1 to win $1. It's what we call 1-to-1 odds. That's where that's coming from.
Bill, ask me what I think is the most important column on this chart, on this table.
What's the most important column?
The middle one. It's the one that nobody wants to think about.
Right.
It's the one
They
that
just look right.
Yeah, they just look at the chance to win. Right.
Right.
If you're doing yourself such a disservice from a risk management standpoint, if all
Horrible.
you think about is how much can I win? How much can I win? How much can I win? The seasoned, the competent, uh, the risk management person
Right.
that's been able to create what's the word I'm looking for? Longevity.
Longevity.
Longevity, right? Sorry. Longevity in this business is the one that's concentrating on that middle column.
Right.
It's the one that you have control over.
Exactly. So here's the chance to win. If we push it to 60%, this is our EV triangle. You can't say I want a 60% chance to win and a 10% chance to lose. The market picks this. Actually, statistics and math picks this. 60% chance to win absolutely means you must have a 40% chance to lose.
And
We
it
divide these out, and what
yeah.
does that tell us? 1.5. The line has been moved. So now if you have a 60% chance to win $1, you should expect that when you lose, it's going to be $1.50. It's going to be 50% bigger. Now, what if we go to 70% chance to win, 30% chance to lose? Look at that. Now we've gone to 2.33. We're over twice what it is for the 50% bet. We go to 80% chance. That's what we saw before. There's 4. But watch what happens if we bump it up just a little bit. Here's the acceleration. Hey, you know what, Stu? Somebody told me that this put expires worthless 80% of the time. I found one that expires 90%. Yes, but that means 10% of the time you're going to lose. We divide these out. You have a $9 loss waiting for you, not 4. So we only bump this up a little bit from 80 to 90, but we go over 2 times. What would that be? 2.25 times bigger. We push it to 95. What happens? We have, I'm sorry, we push it to 95. We have 90, I'm sorry, I did 90%. 10%, 90
95.
divided by 10, now it's 9. Now look at this, 95 is what? 95, 5% chance to lose. It's 19 times. So if you have a 95% chance to win $1, if you lose, the market is going to package that up in a nice, neat single payment of 19 for you. Now, here's where it becomes super dangerous. All things being equal, as we start pushing these numbers higher, that put option that might be trading for 20 cents. And now people say, well, let me sell it 50 times, and I've got gas money for the weekend. We've heard that comment specifically.
You're looking for real money, right? I mean,
We're
what's
looking for real money.
20 cents going to do for you, right? I got to sell it, 50 times.
Or 100 times. But what's 50 times 19 times 100?
It's a lot of money.
It's a lot of money. That's what they're not thinking about. If we push it to 99% chance, which absolutely sounds like free money.
Yeah.
there's a 1% chance to lose, there's a $99 risk waiting for you for that $1. Think about that. You're banging the table about, oh, I've got a 99% chance to win this 20 cents over here. Let me sell it 100 times. You go through COVID or a 911 or something, and now it's 99 times 50 contracts times 100. People, this is what we're talking about, that the risk accelerates. Now, the question is, finally, kind of getting to the presentation here, why does it accelerate? We've covered why these ratios have to work to keep things in balance. But now the question is, why do they accelerate? Very interesting. We have two forces. It's kind of like pinching a watermelon seed between your fingers, right? This one pushes up, this pushes down. What happens? Comes firing out. You have two forces that are causing this to accelerate. What are those two forces? Well, let's say that we have a 50% chance to win. We have 10 people in a room. Let's say that each person takes one contract. How many people win? 5. How many people lose? 5. Now, let's say it's a $1 reward. How much money was won in total? 5. What's the rule? Losers pay the winner. So we have 5 losers over here that have to cough up a total of $5. How much does each one pay? $1. There's your dollar for dollar. At 50% divided by 50% was 1. That's where that 1-to-1 ratio is coming from. But now watch what happens if we have a 60% chance to win. Now we have 6 people who win. We have a total of, this is assuming $1, we have a total of $6 that must be paid out, but the loser pool is shrinking. There's your second force.
Less people paying.
More people winning, fewer people paying. We have 4 losers that have to cough up 6. Each one must cough up $1.50. That's where that 60 divided by 40 was coming up with $1.50. It's right there. Let's say we push it to 70%. Now we have 7 winners of $1. There's $7 total. Think of it like a poker game. It's got to come from somewhere. Where does it come from? It comes from the 3 losers. They have to cough up a total of 7. Each owes $2.33. So again, we're seeing this accelerating force. The winning side is getting bigger, but the losing side is shrinking, and that's what's causing this to accelerate. We push it to 80%. We have 8 winners. We have to cough up a total of $8, but we have only 2 losers. Each one pays $4.
Bill, I just thought of something funny. So if I'm on the losing side of that bet, can I call up like 1-800-SIBO or customer service and say, can we make a deal? How can we fix this?
Nope. They will absolutely, worst case is, even if you go negative equity, they will freeze your account and come after you legally.
Yeah. I'm being an idiot here, people. Look, you can't fix this.
No.
There's no fixing
There's no fixing it. And we've had people ask us that, what do I do? Well, you got to somehow take out a second mortgage, do something. You got to cough up.
You got to eat it. But I have the money in my account. Okay, it's your money in your account. Now you have less money. Okay.
Yep.
Right. That's the deal. You can't fix it. You can't repair it. You can move forward and maybe do another trade. And then if you want to play games with accounting spreadsheets, you can place the one you won against the other one and, call it a repair.
Say I repaired it. Right.
That's funny money. But that's what's going on here. You can't fix this.
No. So let's take a look. One last one. I think you see the pattern here. If we have 90% chance to win, we have 9 winners winning $1. There's a total of $9 that must get paid. We have only 1 loser who now has to foot the whole bill.
Yeah.
So that's what's causing the acceleration in risk. We have a pool of winners that is growing, but we have a pool of losers that is shrinking. And it's those two forces that are causing this acceleration of this ratio. These people could all win $1. This person loses 9.
Again, I gotta say this. As a trader on the floor for almost 3 decades, I mean, I sold a lot of contracts.
Oh yeah,
hundreds of thousands probably over my career.
Oh, I'm sure easily,
and continue to do that. But listen, I'm the guy that was aware, at least after I got beat up a couple of times, of the consequences that you get from the probabilities that you're stepping into. And that's your job as risk management people to to get
Understand this.
understand the process. That's all. Just understand the
Right.
process,
Right.
and be comfortable with potential
Right. So before
outcomes.
you right. So before you say, well, my brokerage platform shows a 90% chance of winning 10 cents. Hey, if I do it 100 times, I can get gas money for the weekend. We've actually heard that, or dinner for the weekend. It's free money. Understand, do the calculation 50 times 100 times that, just in case it bites you.
It's a liability
You survive it.
until it's not.
It's a liability until it's not.
And sometimes that liability is an unknown number. And
Oh, yeah.
sometimes it's not. You do a vertical spread, now you know what the number can be. You don't
Right.
do the vertical spread, you don't really know what that number
It's a
can be.
good argument for using a vertical.
Real good argument.
Very good one.
Real good
So
argument.
let's wrap that up here. Back to our chalk talk question. The out of the money put has an 80% win rate. Again, that's assuming we are on the sell side. Is it safer to go more out of the money and push that rate to 90%?
Yeah, it's kind of a funny
What do
question.
y'all think now? See, again, Trader Talks would say, well, of course, it's a better win rate. It's not finishing the thought.
Yeah.
The answer is it is not safer. In a perfect world, it's equal because they're both fair. Again, in a perfect world, if we were to bet, we know this would be what, 4 to 1. This would be 9, right? 90 divided by 10. But in the long run, they would both be fairly valued. It
So
is not
look, yeah.
safer.
What might you think makes it safer?
That's a different story.
Right? This is where the money comes into it.
Correct.
Right? The money, if the money were equal, I guess it'd be safer, right? But the money is not equal,
Right.
and therefore it's like your compensation is not equal.
That's
So
right.
therefore you can't really say safer. By itself safer, I guess so, but you can't have that conversation unless you talk about the money.
It's a lower probability. It's a higher win rate for sure, but that doesn't mean it's safer
Right.
because
Right.
it's forgetting that the other side is going to move the odds to balance that. So that's the main thing that we just want people to understand. We hear this all the time. Stu and I are constantly just shaking our heads going, man, these people just don't understand it. And this is why we've seen so many people burn out. I've seen at least a couple of consequences where people went negative equity to the tune of about $500,000 or $600,000. Think about that one, Stu. How'd you like to get that phone call? Stu, we need a check from you for $600,000 by Friday just to get your account back to zero.
Bill, I don't have to think about it. I was
It's
that guy
of
early in my
course, yeah.
career.
You've seen that happen, sure.
It,
You've seen
it
people carry it
happens.
out,
That's
sure.
just how it happens. Till look, there's a saying on the floor: if you don't blow out once in your career, you're not taking enough
Take enough
risk.
risk, right?
And it's kind of a weird thing to say, but it's kind of true in a way.
Hmm.
It's how we learned to wake up and say that'll never happen again.
Yeah. So anyway, we just don't want to see that happen to you. It's different when you're
Yeah.
in a firm. It's very different when you're an individual trader trying to make money. We just want to make sure that people are getting away from this idea that the further out of the money you go with the naked puts, the safer it is. Why? Because the risk accelerates. That's the part to never forget. So I hope you picked up some good stuff, and we'll see you next week on Coach's Corner. We'll see you then.